Welcome to the XRP podcast. I am your host, Andrew, the XRP Maximalist. If you'd like to join me or contribute to the podcast, you can find me on Twitter at XRP Podcast with 2 Ps. This is where you can connect with me directly with suggestions, ideas, or any form of constructive inquiry. This episode of the XRP podcast is featuring Chapter 5 of the report on central bank digital currencies from the United Kingdom's House of Lords and Committee of Economic Affairs. During our reading of Chapter 5, we begin with the brief conclusion that the House of Lords and Committee of Economic Affairs came to after their analysis of the various functions, use cases, implications, and reasons for the implementation of a central bank digital currency in the financial system. After, we will dive into a summary of the various conclusions and recommendations made by Her Majesty's Joint Task Force regarding central bank digital currencies and the potential to be taken advantage of on both a retail and a commercial scale. If it is your first time listening, I would recommend beginning from Chapter 1, which features an introduction that provides a summary and basic understanding of the terminology, technology, and context of the House of Lords report. This audio series is organized so that the listener may listen to different chapters in any order they wish, so that the information may be consumed in more palpable, bite-sized chunks. Now, to bring an end to this report, I hope all listeners will enjoy Chapter 5. Chapter 5. Conclusion. We have yet to hear a convincing case for why the United Kingdom needs a retail central bank digital currency. While a central bank digital currency may provide some advantages on speed of settlement and cheaper and faster cross-border payments, it would present significant challenges for financial stability and protection of privacy. Furthermore, a lot of work remains to find workable solutions which do not entail difficult design trade-offs, which may make a central bank digital currency unattractive. Earlier in this report, we put several questions to the Joint Task Force which needs to be answered. Crucially, it should set out the most significant long-term problem or problems to which it believes a central bank digital currency may be the answer. And its assessment should compare CBDCs against alternative means of achieving the same aims. There are several other questions that should also be answered before deciding on whether to issue a central bank digital currency. First of all, how can a central bank digital currency be a competitive payments option without causing a level of banking sector disintermediation that would have negative consequences for credit allocation and financial stability? The next question, what additional monetary policy options would a central bank digital currency provide to the Bank of England? And would these be proportionate to the bank's current mandate for monetary and financial stability? Also, how can a central bank digital currency ensure strong privacy safeguards while also meeting financial compliance rules? Which organizations will be able to access sensitive CBDC payments data? And for what purpose will that data be used? Our final question, what are the main international and national security risks that arise from a central bank digital currency? And how can these be managed? How can a CBDC be made secure against current and future threats without sacrificing usability? While there appear to be no significant advantages for the United Kingdom in being an early adopter of CBDCs, we recognize that consumer payment preferences, technological developments, and the choices of other countries may enhance the case for a UK CBDC in the future. The long lead times involved in scoping and developing a CBDC means the Joint Task Force should continue to assess the rationale and the technology in preparation for such a measure possibly being needed in the future. The government and the Bank of England should continue to work with international partners on principles and standards while learning lessons on technical design and usage from the experiences of countries that will introduce a central bank digital currency soon. End of conclusion. Summary of conclusions and recommendations. Central bank digital currencies. Digitalization is transforming payment systems, and governments must consider what responses are necessary. Any UK central bank digital currency would have far-reaching consequences for households, businesses, and the monetary system for decades to come. Parliamentary scrutiny should be an essential part of assessing the case for a CBDC, and if the government decides to proceed, Parliament should have the opportunity to vote on any financial decision, along with the governance arrangements for any such system. During the passage of primary legislation, the government should set out the costs of introducing and operating any design that is proposed. The Bank of England has consulted on 7 different ways in which a CBDC could support the bank's objectives to maintain monetary and financial stability. However, a CBDC cannot be designed to support all 7 objectives equally well, and there are likely to be alternative solutions for enhancing the payment system with fewer risks. When the Joint Task Force publishes the use case for a possible CBDC in 2022, it should set out the most significant long-term problem to which it believes a CBDC may be the answer. Its assessment should compare CBDCs against alternative means of achieving the same aims. Households and businesses. A central bank digital currency system has potential to spur innovation and greater competition in payments, in addition to those that are already taking place, which may reduce card fees paid by merchants. However, we have heard few other significant advantages for UK consumers. We recommend that the Joint Task Force include a greater number of representative consumer groups on its engagement forum to help it identify whether a CBDC would provide any benefits to individuals and households. We heard the UK's existing domestic payment system is secure and efficient, and it continues to foster innovation and the expansion of services. We know cash continues to be widely accepted in the UK. If this were to change, it is not obvious that the properties of CBDCs would satisfy any residual demand for cash, which is often valued for its physical properties and the privacy that it can provide. We note that the Bank of England has said that it will continue to issue cash on demand, and the public need for money without default risk is covered by most savers by the availability of cash and deposit protection. We also note that a core aim of prudential regulation is to ensure we have a stable banking system. This, together with the deposit guarantee scheme, should ensure that the confidence in the monetary system is anchored. Should cash acceptance decline significantly, a central bank digital currency could be a way to ensure greater financial inclusion, in that it would provide access to digital payment services that are like bank accounts. However, for some, not having a bank account is a choice, and for others, the technological requirements for CBDC transactions may exclude them from accessing it. It is likely that there are more straightforward and targeted ways to support access to financial services than to launch a CBDC. Cross-border payments can be expensive and slow. CBDC systems could, in theory, bypass some of the existing frictions in the international payment systems, with lower costs even. Nevertheless, a central bank digital currency system would still have to comply with oversight frameworks, national laws, and international technical standards, which are a long way from being agreed upon. Cross border payments are already improving as a result of innovation and competition in the fintech sector. A lot of international collaboration is underway both in the private and public sectors, including at the G7 and the G20 levels, to further improve cross border payments, which will make them more efficient with or without central bank digital currencies. CBDCs and the monetary system. We heard that some central banks are concerned that big tech companies, crypto asset technology, and their vast network of users to launch a digital currency capable of rapid adoption by large numbers of people. While we agree this is a risk, the introduction of a central bank digital currency may not be a necessary or complete response. You see, private entities of a size that can compete with the existing payment systems can and should be regulated. The Joint Task Force should set out to answer the following questions. What is the precise threat to the monetary system, which is posed by privately issued stablecoins and other crypto assets? What could a central bank digital currency actually do to offset that threat? And what is the role for regulation? We welcome the work of governments and financial watchdogs in recent months to start identifying ways to regulate issuers of crypto assets. While it is yet to be established whether any future UK CBDC would bear interest, over the last decade, many central banks have become accustomed to new unconventional monetary policies. A CBDC would provide them with new options for responding to crisis. However, the application of monetary policy should not be a motivation for introducing a CBDC. Such measures would likely increase the bank's role and their influence in the economy substantially. Scrutiny of any changes to the Bank of England's monetary policy toolkit is essential. We recommend that the Joint Task Force publishes its assessment of the potential for monetary policy via a CBDC in its 2022 consultation. This will assist such scrutiny. Introducing a CBDC will lead inevitably to some disintermediation of the banking sector, although how much is certainly uncertain, and will depend on how a CBDC is designed. Higher levels of disintermediation would likely lead to more expensive credit and tighter lending criteria. Without safeguards, CBDCs could exacerbate financial instability during periods of economic stress, as people would likely seek to replace bank deposits with CBDCs. There are two main options for reducing the negative effects of disintermediation. The first is to limit the amount of CBDC that can be held or spent. The second is to disincentivize use by paying uncompetitive or prohibitive interest rates on CBDCs above a certain level of holdings. Either of these options, or a combination of both, would likely reduce the attractiveness of CBDCs to users, depending on their stringency. This could undermine other possible objectives, such as increasing financial inclusion or crowding out privately issued stablecoins. We recommend that the Bank of England conduct further studies to assess what would be the effect on the banking system if more than 20% of deposits are converted to CBDC. Widespread adoption of any CBDC would depend on a high level of public trust. While there are design options that would provide some privacy safeguards, technical specifications alone may be insufficient to counter public concern that a government might use a CBDC as an instrument for state surveillance. The bank risks being drawn into controversial debates on privacy, which could undermine its reputation for independence from the government. The Bank of England has indicated that it favors a private sector led approach for managing Know Your Customer (KYC) checks. However, there is significant public concern over control of consumer data, particularly by big tech. The requirement to provide Know Your Customer checks may reduce the incentives for new customers to provide CBDC payment services, particularly if the checks are onerous or expensive to complete. While conducting such checks will be necessary, their costs may undermine the objective of using CBDC to spur private sector innovation or limit involvement to the largest companies or those who have existed the longest. We have heard that a digital identification system may be an effective component of any central bank digital currency payment system to ensure compliance with legal requirements. However, the Bank of England's March 2020 discussion paper mentions the possibility of digital ID only in passing, and the Department for Digital Culture, Media, and Sports January 2021 consultation on digital ID does not mention CBDCs at all. The Joint Task Force should set out whether the government's work on digital ID now relates to its work on CBDCs. International implications. In the short term, barriers to creating interoperable cross-border CBDCs are formidable. While a growing number of central banks are investigating this possibility, complex agreements on standards, design, and governance would have to be agreed by all countries concerned. However, arrangements between small groups of countries could be negotiated more quickly, and it is clear there is political will in certain countries, including China, to create alternatives to the established international payment system, including through interoperable cross-border CBDCs. While this may be a distant prospect, if such payments architecture is implemented effectively, the pressure on the US dollar as a payment currency will increase. This trend could erode the US dollar's sanctions leverage, helping countries seeking to evade economic sanctions to bypass US dollar-dominated systems such as SWIFT. We recommend Her Majesty's Treasury's Office of Financial Sanctions Implementation assesses whether similar risks exist for sterling and the euro. It should also assess the development of CBDCs by countries which are a threat to UK security and any implications for the effectiveness of economic sanctions. There are two clear security risks for a CBDC system. The first is that individual accounts managed by the private sector could be compromised as a result of cybersecurity weaknesses. The second is that a CBDC system, as a piece of critical national infrastructure, would be a target for attack from nation state or criminal actors. Such attacks would risk the exposure of sensitive payments data and the loss of national wealth. No design will absolutely guarantee security. Any central bank digital currency would need to be designed so that it was adaptable and that it could be updated rapidly in response to technological change and emerging security threats. While other countries are developing and testing central bank digital currency technology faster than the UK, the government should prioritize opportunities to collaborate with its international partners in order to shape the emerging CBDC systems. The UK would derive most long-term benefit by ensuring global standards and rules on governance, privacy, security, and interoperability are compatible with the national interests and values of the UK and its allies. A wholesale CBDC would be less disruptive than a retail CBDC with fewer economic and political risks. Although the wholesale operations of the monetary system are already highly efficient, a CBDC may help to further enhance efficiency in securities trading and settlement. Further exploration and experimentation are necessary. Her Majesty's Treasury and the Bank of England should assess whether the work on wholesale CBDCs being undertaken by some of the UK's economic competitors poses risks to UK competitiveness. We also recommend the Joint Task Force consults on the use case for a wholesale CBDC alongside its 2022 retail CBDC consultation. Conclusion. We have yet to hear a convincing case for why the UK needs a retail CBDC. While a CBDC may provide some advantages on speed of settlement and cheaper and faster cross-border payments, it would present significant challenges for financial stability and the protection of privacy. Furthermore, a lot of work remains to find workable solutions which do not entail difficult design trade-offs, which may make a CBDC unattractive. Earlier in this report, we put several questions to the Joint Task Force which need to be answered. Crucially, it should set out the most significant long-term problem or problems to which it believes a CBDC may be the answer, and its assessment should compare CBDCs against alternative means of achieving the same aims. There are several other questions that should also be addressed before deciding on whether to issue a CBDC. How can a CBDC be a competitive payments option without causing a level of banking sector disintermediation that would have negative consequences for credit allocation and financial stability? What additional monetary policy options would a CBDC provide to the Bank of England? And would these be proportionate to the bank's current mandate for monetary policy and financial stability? How can a CBDC ensure strong privacy safeguards while also meeting financial compliance rules? Which organizations will be able to access sensitive CBDC payments data? And for what purpose will that data be used? And finally, what are the main international and national security risks that arise from a CBDC, and how can these be managed? How can a CBDC be made secure against current and future threats without sacrificing usability? While there appear to be no significant advantages for the UK in being an early adopter of CBDCs, we recognize that consumer payment preferences, technological developments, and the choices of other countries may enhance the case for a UK CBDC in the future. The long lead times involved in scoping and developing a CBDC means the Joint Task Force should continue to assess the rationale and technology in preparation for such a measure to possibly be needed in the future. The government and the Bank of England should continue to work with international partners on principles and standards while learning lessons on technical design and usage from the experiences of countries that introduce a CBDC soon. End of conclusion. Thank you for listening to the XRP podcast. I am your host, Andrew, the XRP Maximalist. If you'd like to connect, you can find me on Twitter at XRP Podcast with 2 Ps. This was Chapter 5 of the UK House of Lords and Committee of Economic Affairs report on central bank digital currencies. As always, links to the report will be posted in the description. The XRP podcast is now on YouTube. You can enjoy Chapter 5 with the associated text in tandem displayed on all of your devices. To further understand the report, I do recommend going back and listening to different chapters while taking notes on any information that you may have missed and could find deeper meaning within. I would like to thank the viewers for joining me on our journey through this report, and I am excited to share with the viewer the next feature focus on the XRP podcast regarding central bank digital currencies, Project Dunbar, a technical prototype built on Corda and Partier, which explores how a common platform for multiple central bank digital currencies, which was referred to as CBDCs in the UK House of Lords report, could enable cheaper, faster, and safer cross-border payments. This prototype also proves that the concept of multi-CBDCs is technically viable. Beginning next week, Project Dunbar starts on the XRP podcast. As always, this is made with love for and by the XRP community. I thank you and take care.